Stop stream. Just give me a moment. Yo, morning everybody. Morning Sui, Raheem, Degenology. Okay, we're going to talk about a lot of things. Some stuff to do with the ranges, a lot of stuff to do with CPI, aligning yourself with institutional order flow, predicting expansion. We'll touch a little bit on applying this to Forex, high impact news events, and how to know if you're ready to start live trading. Yeah. Okay, so first I want to go through something a little bit CPI related. So this, in my opinion, is a really good example of what CPI day looks like. If you look at this from, oh, it's wrong on it. Okay, you'll have to use the timestamps that are in the picture. From the 12th of August, that's the 12th of August, until the 13th of August, this was a CPI day. We open up, Judah swing lower, that's for the London session, creates the low of the day, consolidates a lot, and then going into CPI, that's where we get the volatility, where we send price higher, trade back below into the data low, and then finish off the rest of the daily range. So if you notice the difference in between the volume of the candles and the size of the candles before CPI comes out versus after it comes out, you can see that we're going to get way more volatility and way more back and forth price action after CPI. Now that's a typical CPI day. Sometimes it'll move very one-sidedly after CPI comes out, but that's with any news event. When you have CPI, and well, usually you want CPI and then PPI the day after, but today's going to be a bit different. PPI was yesterday, and CPI is today. So we're trading within a pretty small range. It's nothing huge or anything. It's like 60 handles. Our daily range so far is 84 handles. So you can expect CPI to bring in large expansion. If you go to your daily chart and you look on your economic calendar and you just look at the CPI days, it's usually CPI days have a lot bigger candles than non-CPI days. So today we have CPI, expect an expansion day in one direction. And then the day after a CPI day, if you have no high impact news, you'll get a low volatility day because CPI usually brings in a large expansion, and as we know, after a large expansion, you typically get an inside day. But today, we've got CPI at 8:30 in 10 minutes. We're just looking for that to bring in a large amount of volatility and basically show us what the market's going to do for the rest of the day and how sentiment is going to be engineered before the market open at 9:30. Before looking at London, there were no silver bullets in London. I guess technically you could say that was one, but it really wasn't. You didn't have any real great draws, and you don't really want to be trading ahead of CPI. So on the CPI day, you're not getting any large institutions or banks trading until CPI has been released. There's no conglomerate liquidity before CPI is out. So you want to wait until after before you even look to take a trade. Now you can read the narrative and you can look at where they're engineering sentiment, where people are seeing price and where the mass amount of people are expecting it to go. But your trading should be done after CPI, nothing prior to that. Unless you're trading the pre-market model, which sometimes does work out, but today's not as good. Well, I guess it did drop into that order block, turtle soup, and then trade back into the relatively equal highs. So it did form, but just not very clean. Okay, I want to look at New York PM yesterday. We had a very nice New York PM silver bullet. So we'll just go through that now. If you haven't watched the Advanced Market Structure Shift lecture yesterday, you need to go back and watch that because it was very important, and I'm going to reference things in that lecture today. So yeah, watch that one and then come back to this. So on the 15-minute chart, this is New York PM. This is what we're referring to. We have bearish order flow. Every up close candle is providing resistance to down close candles. Basically, the bearish order blocks are delivering price lower. And going into yesterday's PM session, we had the bearish order block and the bearish SIBI. What did I say in the earlier lectures about bearish order blocks, or any order block with a SIBI next to it? The higher probability, and the SIBI is more likely to get traded into. Here it trades into, it gives you that institutional order flow entry drill. So by that point, you can start framing the idea that we're probably going to trade lower for the rest of the day. New York PM as a continuation of the New York AM session into this new day opening gap from September the 9th. And then this one as well. I'm going to put the 5-minute chart, and then we'll go through the breaker blocks and market structure shifts. Okay, so before we go into the PM, we're looking at this breaker block going into the PM. So we have this low, trade up into the SIBI, creates intermediate term highs. This is a high, a low, so we break down below that low that was formed. Some people would assume that's a market structure shift. It's not. So that's a lower low. So we have a low, a high, a lower low, and then we trade back into this. So that's a higher high. And then we trade back down again, getting this lower low. So low, high, lower low, higher high, and then low, high, lower low, higher, lower high. So this is a mitigation block. And then that would be the break, that high. Yesterday, we said every single reversal in price action is going to contain some form of either a breaker block or a mitigation block. Here we have a low, high, low, low. Oh shit, that's wrong. Higher low. So that is a mitigation block. You're looking at that as a mitigation. And then you want to align your market structure shift with, again, some form of breaker or mitigation. The breaker blocks are going to serve you better. So obviously this is just going into the PM to give you a bias. We can remove that now. Clean that up. So going into PM, we create this high, we trade above it at 150. That's when the macro begins. So although we have the opening range for the PM session from 1:30 until 2 o'clock, we can allow entries from the 150 macro, just like we do in the New York AM session. It's the same principle that applies there. So we trade into this inefficiency. We trade above that high one time, and then above that high again. So that's a 3 drives pattern. High, higher, high, higher, high. Then we break down lower. We get this market structure shift. That's one market structure shift. And then we get another one. Which one would you use, or like which one would you place more emphasis on? Well, it's not just about where the low is, it's about how price reacts to that low. When it reacts like this, and there's not really an inefficiency there, am I super confident in that? No, I want to see something else. And then we break down lower again. So that to me is an even better market structure shift. We get a break lower, we trade up into this bearish order block, but for me that wasn't enough, even though it is in the new day opening gap. And then we trade back below that market structure shift again, put in this order block, trade into that order block, wick off of the new day opening gap low, and then we start getting our bearish order flow again. Turtle soup entry, back into that bearish order block. That's optimal trade entry as well. Optimal trade entry again. this. Look at that. Then retrade back into that bounce price range, and then eventually we drop down into the new day opening gap from the 9th of September, which is there. Isn't that first down close candle a SIBI on the first market structure shift? Let's see. This one? Oh, this one? Yeah, but it doesn't trade into it. Oh, it does. Oh yeah, I guess you could use that then. Yeah. But there's no harm in waiting for more confirmation. Okay, CPI is coming out in a few minutes. In the build up to CPI, yeah, the recent candles before CPI are sometimes going to have more volatility. That's just because we're building up to a high volatility or a high impact news event. We've been held in a really tight consolidation for pretty much a couple hours. So that's a small range. And if you remember what I said yesterday in yesterday's lecture, small ranges lead to large ranges, which lead to small ranges, which lead to large ranges. So we're looking at probably a really big move. When there's high impact news like CPI, like a non-farm payroll that week, you want to be more critical in your analysis, especially when you're looking at your daily analysis, your predictions for what's going to happen. Rather than trying to predict the whole day, like I usually try to do, I just identify something that we should draw towards, and then that's enough for me. I don't need to try and predict everything that's going to happen in that day. So in the build up to CPI, you want to see something that's engineering a sentiment. But if we've been building up higher all day, like we have, generally the assumption is that CPI is going to want to run on anyone who's trailing their stops, or it's going to be an outright reversal completely the other way. Now, my higher time frame bias is bullish. I think we should trade towards our all-time high. So I don't want to see it completely reverse. I want to see it hit trailing stops somewhere like this, somewhere like that new day opening gap, maybe the London low, and then I want to see something that offers us the narrative, the idea that retail is being placed offside again, going into the market open, and then the market open trades higher into or towards our all-time high and our previous day high. So with high impact news events, you don't really care about the data that's coming out. I don't care what the CPI numbers are. I'm looking at who's being placed onto which side of the marketplace. Who's getting in here now? Well, retail have been sitting through this for hours, and then out of the blue, we get from 8:23 we get a couple of really large candles. So that's, getting everyone excited, getting them on their feet. They're looking to trade now. They're seeing that volatility. Oh, we just took out this as a resistance, or it's a supply zone, or a support zone. You can capitalize on that, but you don't do it by trading CPI. You do it by building narrative going into the market open. You never want to trade CPI. It's just too volatile. The first tick after that CPI news data is released is a gap. So it's never going to be just normal trading. It's going to be something like this, and then it's going to gap higher like that. You can't trade effectively that gap. You'll get slipped out of your position. See? I wonder how many people just blew their accounts. I wonder. Below the London low. Okay, now we'll see if that is, within the next half an hour, we'll see if that's going to be an outright reversal, going lower. I don't want it to be. I want it to have taken out all these trailing stops and then trade higher towards our all-time highs. That's the most ideal situation for me. You're not looking for the silver bullets here. Generally, when you have high impact news that isn't CPI or non-farm payroll or FOMC or whatever, if it's at 8:30, you can look at it as another market open. So you can treat that high impact news as that 9:30 time. However, when it's CPI, you don't do that because this is too much volatility. Okay, so that's a data low. Everyone's probably placing a lot of emphasis on this data low, but if it's against your draw that you're going to end up going higher, you wouldn't even look at it. So yeah, you can annotate it, but this isn't going to be relevant to me if I'm bullish until we take out all-time high, and then maybe we can come down into this. But I wouldn't even want to consider that if this does indeed show the idea that we're going to be trading towards our all-time highs. Okay, I did highlight this in Discord today, but this looks like a market maker model to me. A little bit. See it's that end. Okay, so it's just short of the consequent encroachment of this busy. Okay. Obviously, don't be chasing price here. You want to wait, 15 minutes bare minimum before you can get some kind of sentiment and gauge on what price is going to do, where liquidity is being engineered, etc. Have to do a lot of waiting today, so we have to fill that gap in time with something interesting. I do want to talk a little bit about, I know there's only 23 people here, but it's fine, about if this model is right for you. Now, I think the silver bullet is a great starting model. I think it's amazing if you're just looking at, you have a limited time window to trade. You can only be in the charts for 1 or 2 hours. And it's pretty simple. You're looking for a few steps, a few salient points of liquidity where it's likely to manipulate. You enter on the market structure shift. The market structure shift and the reversal pattern, in my opinion, are the hardest part of the model. As long as you can get good at that, you can be pretty good at a silver bullet. But say you can't even be in front of your charts effectively or in a way where you can actually focus during those time hours. So for the PM session, it's 2 to 3. For London, it's 2 to 3. Also 3 to 4. For AM, it's 9:30 till 11. If you can't be in front of your charts at those times, obviously you don't want to be using this model. But what if you can and you just don't like the model? I think that one mistake a lot of people make is feeling like they have to be on the 1 minute chart. If anything, it's probably easier to trade on the higher time frames like the 5 minute, the 15 minute, the hourly, and the 4 hour. I'm not saying you have to go onto the 4 hour and swing trade your way to profitability, but you can just trade with a 4 hour bias and a 15 minute intraday chart using pretty basic power of 3 concepts like the classic buy or sell day, and that can be your model. And that only happens, 2 or 3 times a week, but you don't have to sit in front of the charts. You just have to click that position on, leave it, and you're done. And if it hits take profit, it hits take profit. If it hits stop loss, it hits stop loss. There's no real trade management you have to do. It's easier on some people to not have to sit in front of the charts for a long time. You just go on it, you look for the setup, enter or don't enter, come back tomorrow. So you have to figure out what trading style suits your personality. For me, I like both. I can do these 1 minute short-term bias intraday scalps, but I can also, and I do swing trading or day trading or short-term trading. For me, I liked all of them. What I do the most, obviously, is going to be the 1 minute chart because I just get more scalps here. I have quite a lot of models where sometimes I'm trading the Asian ATM, sometimes I'm trading the pre-market model, the silver bullets, the 2025. We have a lot of different trading models, and you won't really know if this one is for you, if your personality matches with this, until you get in there and you start doing it. I'm not saying you have to go out and risk money, but if you haven't been tape reading and backtesting in your own time, or if you have and you haven't really taken a tone to that model, ask yourself honestly, first of all, have you met the criteria to be able to say, yeah, I don't like the model? And what is that criteria? It's having backtested it 80, 100, 200 times, and being unfamiliar with the results, or not liking the way you have to trade compared to other ways. So, say you're trading the daily power of 3. That's a really easy setup that it's not going to happen every day, like a silver bullet, but for some people, they don't need it to happen every day. They don't need to be in front of the charts every day, or they can only be there for 3 days of the week, or they have time restrictions, or if they don't have time restrictions, they just prefer trading on higher time frame charts, like the 15-minute. You have to figure out if you've gone through this entire mentorship. It hasn't been a waste of time, regardless of if you've gone through the entire mentorship and you don't enjoy or take an affinity for the silver bullet model. Some people are just not going to like it. I don't like certain models. I don't like, I don't like turtle soups that much. But I love the 2022, the optimal trade entry, the sweep of a high going into an order block. I love those types of models. I can do that all day. But I don't like a model where on a high time frame I'm waiting for something like a 2022. Whereas on a lower time frame I can do that, and I love that. So all this is just to say, the only way you'll truly know if the model is for you is by going through the motions, doing the mundane tasks like tape reading for a month, like backtesting for over 100 trades, forward testing it on a demo account. Those things you can't skip, and if you do, A, you're not going to get the right results, B, you'll never know if you're actually trading what your mind or your trading style takes to. Like, silver bullet, it can happen maximum 3 times a day in the given time windows that I've given you. And we'll talk about applying it to Forex a bit more later. But say you prefer Forex, you're not going to find as many silver bullet setups as cleanly as you will in the futures charts. In that case, you wouldn't, or I wouldn't, trade silver bullet. I would trade something higher time frame, like the classic buy or sell day, or London reversals, or London turtle soups, New York continuations. You don't have to limit yourself to the 1 minute chart and the 5 minute chart and the 15-minute chart. You can absolutely go into the 4 hour, decide your bias, drop down into the hourly, and just trade like that. You can trade raw price action. I don't recommend trading raw price action, but you absolutely can. So decide, and don't decide just right now. You have to actually backtest and go through the hard stuff, the stuff that no one enjoys. No one really enjoys backtesting. I don't. Forward testing is different because you're in a live market environment, but Backtesting sucks, but you have to do it. What's your take on time cycles? The way I see people using them is similar to purge and revert and silver bullet. I haven't looked into time cycles that much. I think um, from what I know about them, they seem okay, and I guess technically like everyone kind of uses them, just not directly. Oh, this is a time cycle. That's a time cycle. I get the concept of time cycle being like an opening range, but I don't know. I've never really used them that much. Solid advice. I wish I had years ago. Yeah, same. Now, time cycles. I like quarterly theory. Not all of it. I don't like everything Day teaches, but some stuff like stacked and sequential SMT, SMT across 2 quarters, and stacking true opens. I like that, and precision swing points. I like the quarters of the day. I don't use the microcycles. I don't use time cycles. Um, I don't even use quarterly theory that much. Like if I'm on a 1 minute chart, I'm not using it. If I'm on a 15-minute chart, I'll consider it as a confluence, but it's not the basis of my trade ever. Coming back to the point, everyone has different personalities. Some people have, quick minds like ADHD minds, TikTok brains, and they like to switch up constantly. So trading a 1 minute chart for you, that's probably the better decision. If you're more mature or slower, or you're very set in your decisions, something on the higher time frame is going to be better for you. And in that case, what I'm teaching in terms of the model won't apply, but everything else in terms of tape reading on a 1 minute chart, on a 15-minute chart, on a daily chart is going to apply the exact same. So even though you've gone through this mentorship, if you decide that this model isn't for you, you haven't wasted your time. You've still got a lot of information out of me. Because these markets are fractal, and just because we have a 1 minute candle, a daily candle is going to function effectively in the same way. Yeah, it's going to use a larger range. Yeah, there's other things within the daily candle that we wouldn't apply on a 1 minute chart, but fractally, price moves the same on a 1 minute and a daily. Okay, there's our data high. So that's going to be low hanging fruit for longs that are on today, and that's going to be, I guess you could take a position off there if you enter long here, and the all-time highs where I want to see price go. Maybe today, maybe tomorrow, maybe Friday. The entire week, this week is kind of weird because the first 2 days of the week, zero high impact news, and then the last 3 days of the week, we had PPI ahead of CPI, which is, it's usually the other way around. You get CPI and then PPI, and then we've got more high impact news on Thursday and Friday. Oh, sorry, on Friday. So it's a weird week. It's going to be the last half that has the majority of the volatility. That's why I haven't looked for my classic buy or sell day model this week at all. V, can you touch on the Power of 3 model someday? I am going to do an entire mentorship dedicated to that. It's just I want to do the pre-market model first, and then I'll do the classic buy or sell days, which is the Power of 3 model. Power of 3 is a little bit overcomplicated, I think, by majority of people. It's actually really easy as long as you have, institutional order flow on the higher time frame, and you can anticipate a one-sided market on a daily chart. If you drop down below the opening price on a Monday, Tuesday, and Wednesday, with about 30% of the average daily range, and you have high impact news that day, you can look at buys in between 2 a.m. and 4 a.m. in the London Open or the London Kill Zone with a fixed stop loss of, well, I refine it to average daily range stop losses, but the way it's taught by ICT is you would just use 50 handles. Now, I think that's fine, but you can further refine it, in my opinion, by using a stop loss where you're accounting for average daily ranges instead. So if you can get in near the low of the day that's created in London, I would use a much smaller stop loss than 50 handles, based on whatever the average daily range of the last 5 trading days are. Uh, yeah. Yeah, I need to do an entire mentorship on that. I can't explain that here. It's going to be too much. Maybe one day though. I think we went through yesterday's London, so we'll go through the New York AM. 9:30 opened and we had a crazy 1% fair value gap. It was really large. But okay, so we opened up at 9:30. We created a 1% fair value gap. Why are we using 9:30? Because we had high impact news at 8:30. So when you have high impact news at 8:30, whatever it is, doesn't matter. Then you can use the 9:30 candle as the first presented fair value gap. Normally it's 9:31 until 10 o'clock, but in a situation where you've had the high impact news from 8:30, you can use the 9:30 candle. Then we trade into our data low really quickly, but then after that we get this crazy amount of consolidation. You can consider this a bounce price range. It leaves that bounce price range. You don't want to see it return into that now. So I was in buys here. I think this candle, and this candle. But then it just consolidated, so I got a break even pretty much. Price action yesterday was really bad after or between the AM session. Going into the PM session was really good, but in the AM it was bad. Like, that is not tradable. I can guess a lot of people probably blew their account in that. Because in a time where you expect volatility, you're getting time distortion and consolidation. Everyone's looking at this and they think, okay, it's dropped down, market structure shift, SIBI, let me sell there. Or when it trades higher, okay, it's traded above these highs now, goes into the order block, they buy it, it trades up with that wick, and then stops them out. Consolidations will be the death of your equity, so avoid these at all costs. I have a video on recognizing when consolidation is going to occur. You can have a side series of 2 to 3 videos on Power 3. The thing is, when I'm doing the mentorship and planning the streams and then doing the streams and then being in Discord and then my own trading and then my own life and then weekly outlooks and reviews, doing another series on the side of that as well, it's too much for me, I'm not gonna lie. It's just too much. Okay, so it's been nearly 20 minutes since the news has been released. If we're looking at bullish order flow here, you want every down close candle to be supporting up close candles. So we've had all this up close movement or buy side delivery. We've traded back into the down close candles, aka a bullish order block. CPI has been released at 8:30. Post 8:30 today, which is now basically. Everything before that, you wouldn't want to trade. Everything after that is valid for a trade because this is where, because after the news has been released, large funds like banks, institutions, large entities are going to be looking to put their money in the market. Now, they're not rushing into trades, but they're not trading before 8:30 at all. They're considering trading after 8:30 because that's when the CPI has been released. If we're bullish, inside of the down close candles is where institutions are hedging their sell positions and they're getting into longs. So then when you trade back into this as an order block, that's when you want to see that volatility kick in, and that's why we consider it bullish order flow. So trading above this down close candle would make this a change in state of delivery. Why? At 8:48, when this candle opened up, it was in a state of sell side. It delivered lower and lower and lower, pretty much a full body candle as well. Trading above that and closing above it is flipping the idea that we just traded down into an inefficiency or a BISI. We flip that when we close above it. Ideally, you want the closure to be, not the same as the open. You want it to be slightly above. Displacement's always better, but even slightly above is good. Like that, that's good. So this changes the state and delivery of the 8:48 candle, making it an order block. Do you know if PDRAs on the sell side are being reclaimed when price gets to the buy side of the curve and vice versa? Yeah, absolutely, absolutely. Like you can see this as an inversion fair value gap. I bet some people are looking at this low, high, lower, low as like a breaker or a mitigation. You don't want to do that. When you have a news candle, you typically don't want to use it as a breaker. Sometimes you can if it's not huge, but this is CPI. It created this entire massive move down. We're not using that as a breaker at all. Even though you can see it as a low, high, lower, low, you're still not really using it as a breaker. But yeah, taking PDRAs from the sell side of the curve into the buy side of the curve, or the buy side of the curve into the sell side of the curve, that's always going to be useful. Always, because those PDRAs that formed on this side of the chart, those have already formed. You already know if they're going to be important or not. Like this PDRA is a large one. It's been traded into. I mean, it's kind of a bad example. But something like this order block, it's been traded into. So we know that's a good PDRA. We know that this is a good SIBI. We know that the first presented fair value gap is a good PDRA to look at. Because they've already been referenced in a significant way that delivered a significant price move. And I remember when I would look at CPI and chase price and try to trade it. Gambler. If you are looking at this as an inversion fair value gap, it's pretty nice as a change in state of delivery as well. So this orange hue rectangle, that's the SIBI that formed at 833. We trade above that, we displace above it, so that's an inversion fair value gap. When is an inversion fair value gap going to serve you best? When price doesn't even trade past the midpoint. If we trade into the extreme of the fair value gap, or the inversion fair value gap rather, down there, it reduces the chance of getting a really good rally higher, or a higher probability trade. If I trade into the low, or price trades into the low of an inversion fair value gap, and it's a bullish inversion fair value gap, that to me signifies, okay, could be wrong there, not looking to buy that. If it's like this though, and we're respecting the levels in it, so we either touch consequent encroachment or we leave it. And this is part of the 60-minute model that I have in Discord, where it's first presentation gaps, but the same applies with any inversion fair value gap. Once it gets inverted, you want it to fall short of the midpoint or the consequent encroachment. You're not looking for that to get traded into. And those are going to give you the highest probability setups with an inversion fair value gap. And it also gives you a form of change in state of delivery. Trading above this and respecting this candle, and then trading up into here, that is a form of change in state. What about SIBI above that one, 832? Won't need to displace through both. It doesn't need to. It doesn't need to. Although that is part of the same range, in terms of an inefficient range, you separate them with a wicks. But say that wasn't there and you're just considering it as a range. It's two candles that both deliver really one-sidedly lower. There's no wicks there, for example. You can still refine them down to the candle. So even though that in of itself is the inefficient range, refining it means you go down to this candle. Does that make sense? The main thing I wanted to highlight today is that the difference in between prior to CPI and post CPI in terms of volatility, in terms of algorithmic price delivery, is going to be immense. You never want to be trading, right before CPI. You never want to trade CPI. You have to wait. There's nothing else you can do really except for wait. Post CPI is when you want to be looking at the market. Big players are not going to be positioning themselves ahead of CPI. Throughout the entire week, no matter what day CPI is on, say CPI is on Tuesday and it's a no-news Monday, you really want to avoid a trade like that or a condition like that, because no large fund or entity or large bank is going to be looking at trading that environment. They hedge their positions, yeah, but they're not looking to actively enter new ones like we could do here. Say we're bullish right now and we sell off in this A48 candle. This is where large institutions are getting in. They're not getting in on the up-close candles. They need price to be going lower for them to get into buys. That's how they get their counterparty liquidity. That's why order blocks work. So anything before this isn't going to have that same level of institutional respect or order flow. An order block here isn't going to form the same as an order block post CPI. Something to keep in mind. Something to make note of. This is the weekly chart. I can't remember if I said this in my daily analysis, but I wanted us to displace above the August 18th weekly candle, because this would act as an order block, which currently it is doing, and then I want to see it trade into the all-time high this week ideally. Let's look at forwards. Okay, we're looking at the euro dollar, and again, same situation. Look at how tight this consolidation's held in. And then going into CPI, everything has been cleared out. Every single little bit of buy side or sell side in the last pretty much 24 hours has been cleared out. Low, lower, low, lower, low, drapes higher, goes into the vacuum block, and then we have relatively equal highs there. We have these two down close candles that you want to see traded above. So some kind of expansion higher towards that level, making this a supporting order block, and then going into these relatively equal highs. That would make sense on the euro dollar. What's the vacuum block? Oh yeah. Go back to it. A vacuum block is similar to a breakaway gap, but they want to fill in. So in a news event, when you trade, no, it's not as big as I thought. So 8:30 comes out, although it's not really very visible on this chart. This gap's higher, so it's leaving a lot of little pockets of inefficient price delivery there. It's trading one-sidedly, so it's a form of a fair value gap, but it's more likely to fill in, and there's a lot of characteristics to that. Well, that's for another lesson. Basically, you want to see vacuum blocks filled in. Like a news candle is going to typically be a vacuum block, and news candles typically get mostly filled in. If it's a wick, though, you wouldn't look at it. It has to be a full-bodied candle. Because if it's a wick, it's price delivery both ways, so it's gone from here all the way down there and then back up. So any inefficiency in there has already been filled in. We are in the final days of the Silver Bullet Mentorship. I think there's 3 more lectures I want to do, and then I'm pretty much done in terms of teaching the Silver Bullet, and then I'll move on to something else. I'm not sure what yet. Either the pre-market model or the classic buy-sell day. But I'm thinking of leading with the pre-market model. That's what actually made me pop off in Reddit initially. Like, that's how I got most of my subscribers, because in Reddit I was posting about the pre-market model and everyone was like, it's a new model, it's a new shiny object, and yeah. We have to do so much waiting today. Maybe I should have started this so early. But that's what trading is. You have to be able to sit still. That's where everyone else messes up. They can't sit still. How many people have lost their accounts in that little tiny range? Or in this, expecting it to deliver lower? Even though we're in low probability conditions, you have to sit still. Anyway, I want to go through trade management later on, but we'll have to wait for a setup first, and we'll talk about it. Is London tradable before CPI? It is, but you don't want to do it. It's low probability. Everything before CPI is going to be low probability on the day of. So you wouldn't trade Asia, you wouldn't trade London. Just wait it out. And most of the time it's going to be in such a tight range that you're not really able to capitalize on it as much as you need to. This is a form of time distortion because it's obviously not there, but once we break out of there and then we start consolidating, this entire hour and a half, or whatever it was, about 2 hours, that is all time distortion because it's the algorithm delaying price delivery until we get that CPI news release. And then when that happens, after that is when you're going to see the volatility being put in the marketplace. And you want price to trade away from these areas. The conditions that CPI presents, though, you have to be very careful in risking equity. If you're on a live account, especially if you're on a live account, you should be really careful today because you can get really rapid price swings and they come out of nowhere. So, be careful today. It's a hard market environment today, 100%. 25 minutes until the opening. The reason I want higher prices is because we're near all-time high, and near all-time high, you pretty much want to just be looking at a bullish bias until you're proven otherwise. So until we drop below a protected low like this one, I would just be bullish by default. Anything that goes against that idea of bullishness, like this move lower, for example. So high time frame, you're bullish. Anything against that narrative or the idea that you're going to trade lower should be in your head a suspect rally. Just because we got a couple of down close candles, you're still bullish on a higher time frame. You want this to get inverted, and you want to see this acting as A, an order block, and B, this is a temporary state of delivery to the sell side. You're expecting it to be disrespected and then traded back above, because high time frame, you're bullish. You can take advantage of these manipulations lower, and that's what power of three is. If you were taking classic buy or sell day today, your entry would have been probably this low there. But with CPI, obviously you want to be careful, because preliminary consumer sentiment, inflation expectations. Do we see such amount of volatility as today with the news tomorrow? Probably not at this level, no. But it depends on what the news results end up being. But CPI is generally going to be the largest news event for the week. You're not expecting this same level of movement in consumer sentiment or inflation expectations. Let's go through. So looking at the euro dollar, when we have CPI, you're expecting a large range expansion for the day. So if you're looking at the daily ranges, you're expecting this day to be larger than other days. So in the 2 days before it, we have no high impact news. In the other days, this Friday was NFP Friday, so you have to account for that. But other than that, the idea that we have CPI today, you're looking for large range expansions. So something like that is reasonable. Something like that is reasonable. Something like trading into that range, that liquidity pool. CPI days, typically they're going to have just way bigger daily candles because they're larger in size and volatility in a lot of things. So, expect this daily candle, and this goes for NASDAQ as well, and pretty much anything that's affected by CPI. You can expect a larger range day. So if you're looking at the rest of the daily candles, and obviously you want to align this with the economic calendar so that you're not taking into consideration days like non-farm payroll, where those are going to also be large range expansion days. But, take the no news days, for example, like September the 4th. I don't think there was news on September the 4th. You can use standard deviations on this range and apply it to here. So if that range is, okay, say that range is 100 handles, and it's a no news day, CPI is typically going to be, at least double that size. So you can take this range, apply it to the opening price, and double it. So if that's 100 handles, you go from the opening price, you add 200 handles. or you take away 200 handles, and that would be a potential low or high that you could anticipate it trading towards. And then if you have a liquidity pool that aligns with that, it's a higher probability to expect it to trade towards that direction if you're underlyingly bullish. That probably made zero sense. Why is the data high on candle 831, not 830? Yeah, first. So you're looking not at the candle of the data, you're looking at the one-sided delivery. So, I mean, a lot of people make the mistake of doing this. But what I look at is the one-sided delivery. So we trade it all the way down, and we trade it all the way up, opened up, also closed this candle, opened up the next one, and then we still traded higher and then lower. So that to me is the swing point of the data release. So I would use the 831 candle. So it's about the effect that the data creates, about the range that it puts in. From this high to this low is the range. Just the 830 candle isn't enough. I like to use the entire range. Okay, so it seems like price is slowing down a bit. We have 18 minutes till the market opens. Maybe we'll get a little bit of time distortion. If we do, though, it'd be nice because we can talk about low resistance liquidity runs. This data low, pretend we have no bias. Like we have no bias in the high time frame. Price is held in a consolidation in the high time frame. The data low would be a very strong drawn liquidity and a low resistance run. Why? Because there really isn't that much price action in between here and current market price. We have this low, this low, this low, this low. They're all higher lows. So it goes lower low, higher low, higher low, higher low, higher low, higher low, higher low. It's really easy for price to run through all of that and get into the data low because there's not really any back and forth here. It's higher price, retracement, higher price, retracement, higher price, retracement. That's a characteristic you'll see very frequently with low resistance liquidity runs, where you put in multiple higher lows, where you can consider it a failure swing. And that's easier for price to run through, as opposed to something like, well, like this consolidation. This is an area of high resistance because it's balanced. So if we leave that, trading back into it shouldn't result in you taking out the highs. But obviously we have CPI, so you completely disregard that with a niche candle. Do you expect price is gonna hit all-time high first and go to the data lows or what? I don't know. We'll see. We'll wait. It would be nice if it does take out the data lows, because then we could get a really easy entry into the all-time highs. But we already took out sell side, so I don't think we need to go into the data lows again until we've already taken out the all-time high. So my expectation is that we don't really trade back below 23,838. What are data lows and highs? Yeah, so when the news comes out, today we had CPI at 830. The effect that that has on the market, the range that it creates, that range, you call it the data high for the high of the range and the data low for the low of the range. So this is data low. Because it's the release of the news data that causes that to happen. These are typically good draws on liquidity. However, I think some people often emphasize it too much as like the unstoppable draw on liquidity. you still have to be aligned with your bullish bias. If you're bullish, if price is going to be bullish, it's not going to trade all the way back into the data low, no matter how powerful people say they are. They are very powerful and they're good, but that doesn't mean you ignore higher time frame bias and order flow alignment. You still want to determine your likely expansion on the weekly chart, on the daily chart, on the 4-hour chart, and then you align that with the idea that we shouldn't trade as the data low if we're bullish, and we have that far of a range in between market price and current data low. Yeah, hit the like button, hit the like button. I'm losing my voice for YouTube, so I just confused it with people saying you need to collect data, but I think that's totally it. Yeah, so data collection is so important. Data collection will show you way more than I can show you because you're observing things in price by yourself. Don't worry, I'm building a VAI from these videos. JK. Oh, Valric AI. Okay. You can go ahead. I wouldn't mind talking to myself all day. I'm entertaining. Oh, data collection. Yeah, data collection will show you way more than I can because A, you're making those observations yourself in price, and B, you can do it for more time. These streams are limited in terms of how long they are, in terms of what I want to teach, and I have to cater to the fact that most of the audience right now is a beginner audience. And for people who watch this in the future, I need to have everything explained from the start, like ground up. That's why the first videos of this was so basic, of the mentorship. But data collection yourself is going to show you a lot about the marketplace that you didn't already know. So, like yesterday's lecture, I told you to all look into market structure shifts between 9:30 and 11 o'clock, or your chosen silver bullet window. And I told you to look where the breakers form. And if you can frame a breaker where the market structure shift is, how much higher the win rate is going to be, or how much higher the strike rate on the delivery into the draw on liquidity is going to be than if it was, without a breaker, if it was with the mitigation block, or if it didn't displace through the market structure shift, or 10 other things. So, yeah, data collection is very important. If I get bad results doing backtesting, how can I know whether I should backtest more and learn from my mistakes or focus on studying the theory instead? Well, if you know the theory, then, well, I guess, I'd say just do both. Rewatch the mentorships, or whichever model you're looking at, look into it more, study it more. There's never going to be harm from studying it more. There's never going to be harm from backtesting it more. So, the more data you have, the better. Just keep backtesting, keep refining it, keep studying it. Make sure you're not doing anything completely wrong. Like maybe you think fair value gaps are likely to be run through instead of used as support. That's a bit of an extreme example, but you need to make sure first that A, you're doing the model correctly. If you are doing the model correctly, you need to check the market conditions. Where are you trading? Are you looking at the economic calendar or are you backtesting without it? Are you aligning yourself with high time frame bias? Are you using other discount and premium tools and things to improve your win rate? And backtest the loads. Go to backtest thousands of trades. Would love to see you making video about data collection. I could. Yeah, I'm posting Discord, I'll give you feedback. Yeah. Okay, we have 10 minutes until market open. How's your top step common line doing, V? That was months ago. That was like, I don't know, 2 months ago. No, I made too much money on it, so then we didn't meet the consistency rule, and then I would have had to make 3K again because I hit 3K in one trade. you have to hit it in like 2 or 3 or something, or 2 days, and I hit it in one day, so then I messed it up. We used to do live trades with the top step though as well. I used to signal everyone suffering from success. Well, I don't really use prop firms anyways. I don't like them because they want you to fail. That's how they make their money. We were just talking about this today actually in Discord. You know, they'll give you a 50k account. Say you can lose 2% and make 3% or whatever it is, 4% and 6%. So say you have 2k of drawdown on a 50k account, meaning you'll lose the account if you only drop 2k. You're basically trading with a 2k account, and then they want you to make 3k. So they want you to make 50% more than the account balance is. So that's 150%, which they only give you a month to do. That's something that can take someone like a year or two. And they want you to do that in a month. So the only way to realistically do that is by over leveraging and over trading. So it puts in bad habits where you have to meet that deadline within 30 days. You have to double the account and then make 50% on top of that. So uh, it's unrealistic. It's very unrealistic. You spend 20% less for that 2k balance. Or you spend 20 times less for that 2k balance. I get it, but to get any money out of that, you still have to do something that's like Olympic level. Whereas with a live account, you don't have to do anything for anyone. It's just build your equity, whatever, whichever model you're using, it doesn't matter. You can use any strategy. You can use any. Uh, yeah, you can do whatever you want, and you can do it in your own time frame. There's no deadlines. There's no rush. It's just 1% a day, 1% a week, 2% a week, 8% a month, whatever. I mean, I'm a bit more ambitious than 1% a week, but you build your equity from the ground up slowly, but it compounds over time, and it's going to be more than whatever those prop firms can give you. So my recommendation, well, I can't say my recommendation because I'm not licensed or anything, but if I had gun to my head, would I say prop firm or live account? I'd say live account. In my opinion, those are going to serve you better because it's a more realistic trading approach. Everyone who trades prop firms, their goal is to eventually move into a live account anyways. So just, stop spending money on fundeds when you can just put it into a live. Even if you have to wait for a little bit longer to save up that money, I think it's worth it. But obviously make sure you're profitable first on a demo account. If you're blowing through fundeds, you shouldn't be giving yourself a live account. I like to backtest a 4-hour chart and ask ChatGPT what happened when there are crazy volatility spikes if the economic calendar says nothing on that daytime. I don't think ChatGPT is going to really know, to be honest. Yeah, ChatGPT is not a great trader. That's the best summary of prop firms I've heard. Thank you. Entry fees low, but the ask is huge. Yeah. Live accounts are heavily underrated. People forget the power of compounding. Exactly. That's why live accounts are better because it's compounding to you know to build your equity. Start prop firms with yield more, but in the long run, it's always a live account. Yeah, 100%. Plus, there's no stress if the company's going to end up paying you out, or if they're going to make you adhere to more rules, or if they want to do compliance interviews. there's so many hurdles. It's basically like working for someone. And the entire reason I'm pretty sure everyone gets into trading is so they don't have to work for anyone. So it's a bit of a contrast. Trade micros on the self-funded account. Agreed. You can't make money on a small live account. You can. Just, well, obviously not if it's like $100. You need a bit of a, you need something where you can have an effective risk management protocol. If you're trading with $500, the smallest amount of size you can use is 1 micro, and if you're risking 20 handles, which is a reasonable amount, generally, that's $40 with 1 micro, which is nearly 10% of your account. It's like 8%. So you ideally want to have $1,000 at least before you start. I haven't made any money. I've been listening to Velric and I'll be more unprofitable than ever. Great fraud. You were broke when I met you, and you're broke now. That's a joke. I keep unplugging my mic on accident. I don't know why. I was gonna say, you had a lot of bad habits, and I told you need to break them. And you bought more fund accounts. Come on, Clint. Go back to demos. $500 live account, bro. That's like the payment on a used Lambo. I trade gold. I do trade gold, but the swing trades only. What's your expectation from ICT mentoring 2025? I don't know. I'm excited. I'm very excited. I mean, I'm always excited when he comes out with new stuff. Let's see. He said he's dropping the bullshit act this time around because he's got grandkids now, so he doesn't want to be like the typical marketer ICT where he says crazy stuff, always making these crazy claims. He's just going to be down to earth now. That's what he said. But he did say that at the start of this year and last year. So we'll see. I don't know what he's going to come out with. I feel like there's going to be some forex involved. I hope there's going to be some forex involved. But yeah, forex has been really clean. If you go into Eurodollar, in fact, I'll give a little teaser out. Okay, yeah, it's this one. Some of you can probably reverse engineer what I'm doing here. This is a classic sell day. Yeah, forex has been moving really clean, so I think it'll probably come into forex a little bit. The standard deviations I'm using are from the Judas swing above midnight open or below midnight open, and then this fib here is projecting how far price is going to come off the high or low of the day to make the closing price, and it's been working with amazing accuracy, like that. Amazing stuff. Typically, in a classic buy or sell day, if it's a higher volatility day, the opening price is going to be in the upper 20% of the daily range. So here, there's the opening price, it's in the upper 20%, and then the closing price is there, it's in the lower 20%. So, yeah, I don't know, we're going to do a whole mentorship on that eventually. After I finish this one, I might need a bit of a break. I'm trying to maintain a 50% win rate with 2R. That's pretty good. That is profitable. Oh, market's opened. Hey. There's your opening range gap. V, what do you think is the best model for someone who can only trade Asia or London? If you're trading Asia, Asian ATM model, I don't know why I call it that. Apparently it's not called that, but I just remember it as the Asian ATM model for some reason. I think that's how I learned it. If you look at ICT's 2024 lecture number 5, that would be really helpful for you for Asia. For London, either London's Turtle Soup or London Reversal or Silver Bullet. When we get into the buy or sell, sorry, the Power 3 mentorship, you'll find a lot of London setups as well. But until then, you're stuck. How many trades did I take this week? I don't even know. 8. I think 8. (2024) and what other lectures I should go through for the London Reversal and the other one you mentioned. 2024's lecture number 5 is for the Asian setup. And then for the London Reversal, I don't remember from the top of my head, but it's effectively a turtle soup, but time-based. So you're looking at 2 a.m. to 4 a.m. You want to see price trade below an old low into a bullish order block, and then buy that if you have an underlying bullish narrative. Basically, that's it. And then the rest you apply Silver Bullet to. But if I had to recommend you one, I'd say Silver Bullet. London Silver Bullet is really good. In the resource pack, I think I might actually have put in the Asian model, the ATM one. Let's walk through the Asian session actually, just quickly. So that's a small range. Let me just check my notes. London Silver Bullet, am I going to use 2 to 5 a.m. and what macro time should I use? For London Silver Bullet, you're using 2:50 until 4:10 because you account for those macros on either side of the time window. So the macros will be 2:50 until 3:10 and then 3:50 until 4:10. I live in a time zone that allows me to trade both London and New York sessions. Do you recommend engaging in the two or just be content with one? Both of them. Yeah, why not? If you can afford the time, do both. But, maybe just tape read it. Because it's mentally fatiguing to do both. I don't always do both. I'm not going to trade New York session today. My mind's tired. I'm tired. My voice is tired. I'm just tired. So I'm not going to trade the AM session. But it depends on you. It's not like it's not an answer you can really quantify so easily with that, because if I just say yes or no, I could do that, but it depends on you. Do you get tired after trading in London and then you feel like you have less energy for the AM session, or can you focus on both of them? And do you know what you're looking for? Because if you don't even know what you're looking for, first you should learn what you're looking for, which is in this mentorship. If you're using this model, it would be the silver bullet. This is a bit more of a general stream. There's nothing specific content-wise that we're focusing on. We've covered already the impact of CPI on the daily range, price action, and conditions. Everything else past here we'll do trade management. We're still going to touch on that a little bit. Stop placement, and then let me check the notes. We're going to do a little bit of a protocol for forward testing. I'm not that good at trading yet to be using multiple models. You can use the same model for London and New York, so you can just use a silver bullet for both. I would recommend, if you have the time and you don't find it taxing mentally, to do both, because you'll collect data faster. Eventually, maybe you'll have to evolve into just doing one of them. If you have data on both, then you know which one you're better at. So, twice the data, twice the confidence. Trading's all about data. If you have more data, you're going to do better. Simply. Yeah. Okay, I bet a lot of people are using that as a market structure shift. I would probably use this one. We have a high, low, high, and then I want to see price trade below this, below that low, making it a lower low, whoops, like there, and then that would be a better market structure shift for me, because the market structure shift would be a breaker block as well. So you want to see displacement below that, some kind of breakaway gap. Like if we leave that there as a breakaway gap, that would be really good. And yeah. Plus we have the consequent encroachment of the opening range gap. Our opening range gap today is 100 handles, so it's reasonable to expect within the first 30 minutes of trading that we approach or trade into the consequent encroachment of the opening range gap. And once that happens, you can treat it like a liquidity event where you want to see price use that as resistance, or some kind of signature in price, like breaking away from that with displacement or fair value gap or whatever. Something that gives you the narrative and that little push over the edge that, yeah, it's going to keep going lower. It's something that you can say in your mind, yeah, it wants to go lower, it wants to go lower. Like that. I think personifying price is actually a really good way of looking at it, or a really good way of building narrative. Oops, this chart's not right. When I say personifying price, I mean, comparing it with characteristics of a person. So it wants to go lower to take out people who are stopped or who are in positions there, for example. Or it's breaking away from this gap, it doesn't even have the will to go into that gap, so it should now reach into a higher time frame liquidity pool. Stuff like that. You don't have to treat it like your best friend, but personify it a little bit. I find that helps in reading narrative. A narrative is such an important thing in price. I don't think anyone teaches you how to read narrative. Everyone makes a daily bias video, but no one makes a narrative video. This entire mentorship has been like a narrative reading tutorial, because it's me doing it in front of you real time. Okay, so we took our pre-market high, which is also a data high, with the 930 candle, yeah. We usually, I've said this multiple times in the mentorship now, if you take out the pre-market high with the 929, 930 or 931 candle, you have a tendency of going into the opposite end of the pre-market range. That doesn't mean you ignore your bias and stuff, but generally it'll do that. Okay, so you want this to create a swing point, and then we can look for this to act as a breaker. When do you use the wicks versus the bodies of a breaker block? If you have a really small body but you have larger wicks, use the wicks. If you have a really heavy body and really tiny wicks, you can still incorporate the wicks, but you can refine it down into the body. Whereas in this case, refining it to the body just makes it tiny. You wouldn't use that. You'd use this. Okay, so it did create a swing point. It immediately rebalanced, leaving this order block. It's traded lower. We want to see this close below the opening price of the 940 candle, which would be a short-term change in state of delivery, and then return into that, and then use this as bearish order flow to go lower. Well, I'm not saying it's going to go lower. I am bullish, but if I was reading price neutral, using the data low as a draw, then that would be how I would personify price. Bang that like button. Okay, we want to see if it's got a will to fill in the rest of the opening range gap. So it filled in the upper half, which is from there to here. We've traded into the lower half now. We want to see something to provide resistance. So this SIBI, the new day opening gap. This new day opening gap is from last month, by the way. I found it relevant because we had some reactions to it, so I just put it back on. And you want to see this be able to fill in. Tap midnight. Oh yeah, I didn't even put midnight on. And I didn't even put CPI candle on. There's 8:30 open. 8:30 open's aligned with the upper quadrant of the opening range gap. I understand the chart looks very messy right now with all the annotations, but you're just going to have to deal with it. I wouldn't have my charts like this. I'd probably eyeball this breaker. I wouldn't have the arrows on. I wouldn't have the data high on. Whoops. I wouldn't have the data low on because it's really easy to see. And I wouldn't have the breaker on. So if I was viewing price just by myself, I'm doing this for the stream, but if I was by myself, I wouldn't have any of that on. I would just be looking at the chart like this. And I'd have a blank chart on the left-hand side. Okay, so we've rejected off the order block, bearish order block, and this SIBI. Let's see if we can price below midnight. It seems reluctant to go there right now. Would a stop loss above that breakaway gap be valid? Yeah. Yes, it would. Really, it shouldn't come above the upper quadrant, but it could wick past it, so you would want to accommodate for a little bit of a wick. But yeah, ideally it shouldn't come above that 0.75 level. If I was in a sell, my partial would have been here right at midnight or at the consequent encroachment of the opening range gap, because it also serves as an equilibrium point of the range. So remember how a few days ago we were talking about dealing ranges? Equilibrium is an amazing place to take a partial, especially in a large range. If you're in a small range, you don't have to, but in a large range, you're asking price to go from the extreme into the other extreme. So don't forget that you have to accommodate for the idea that it might not do that. In which case, it would be beneficial to you if you take a partial at equilibrium. So this ties into trade management. How much are you going to take off? You can take off half the trade, you can take off 20%, you can take off 80%. Well, how confident are you in that trade delivering? Are you extremely confident? Because if you are, I would take off a smaller partial, like 20% or 15%, maybe 30%. What that does is it puts a little bit of money in your pocket, and it also reduces your stop loss price. So say you're risking $100, and your stop loss is there. By taking a 30% partial here, you reduce that to $70, and you also put I don't know how to do the maths, whatever, X amount back in. So you're offsetting what would happen if you take that loss by a little bit, and you're also reducing the amount the loss will be. So you'll feel the sting of that loss way less in a trade that you would, if you didn't take a partial, suffer the entire thing. You would take the entire $100 loss. If you take that just 30% partial, it's not a huge one. If you just take that partial and it reverses back onto you into your stop loss, you're not going to feel you're not going to feel as bad about it. You'll probably feel good. You're going to think, well, it's a good thing I took that partial. You'll feel less of a sting. you'll feel pretty happy that you took the partial as well. Partials are very important. Like yesterday, was it yesterday? I think it was yesterday. I had that London trade. I took the partial at the low. It came back into my break even. So my trade idea was incorrect, but I still made money. Being able to do that is, I don't think everyone, it doesn't suit everyone's personality, it doesn't suit everyone's experience to be constantly thinking about taking the partial. Why should I take the partial? Because in their mind they'll be thinking, oh, I can take one at this swing low, at this swing low, at this swing low, at this swing low. And then they're looking at every single point of reference where price could potentially reverse as, oh, it's going to reverse on me. And that puts fear in you. So stick to taking one partial in a trade at most. You shouldn't be going out there looking, oh, where is it going to potentially reverse on me? I should take a partial there. It should be, okay, where has it reached a reasonable expectation? And now it could potentially trade against me. That's where you take your partial. So here, this dealing range from the data low into the New York AM 930 candle high, or 933 candle high. That dealing range, you go to equilibrium with that. Price is just into the discount. That's a good partial. Again, it can be small, it can be large, depending on how confident you are in the trade. I wouldn't recommend taking off half of it unless you're very uncertain in it going past your position. Generally, 20 to 30% will serve you well. It'll take the sting off your loss a lot. and it puts the money in your pocket. And if the trade goes to your take profit and you took that partial, are you going to feel like you missed out and you shouldn't have taken that partial? Maybe you will, but you shouldn't, because the idea that, oh, it skews your risk to reward ratio. The second you trade with live funds, you'll realize that no, it doesn't. It protects your equity. It allows you to pay yourself before you've even, got halfway through the trade. And when it reverses on you and it hits your stop loss, and a loss that originally would have been whatever $100, but you only end up being down 20. Just from a 30% partial, you've reduced the amount of loss you can take from $100 to 20, without even needing to trail the stop loss. So that level of trade management, you won't have that immediately. It takes a while to build it, to think effectively in terms of where's it potentially going to trade against me, without putting the idea too firm in your head to be overcomplicating it and overthinking. Oh, it's going to reverse here and here and here and here. The second it reaches midnight, oh, I should take a partial. The second it reaches the new day opening gap, partial. The second it takes 0.25 partial. That level of trade management is harmful to you, and that will skew your risk to reward ratio. But when you're, doing it in a manageable, sustainable, repeatable way, where you just take one partial, you don't need a lot. You can just take one partial at a reasonable point of either discount pricing, where it could potentially reverse on you and trade back into premium, or equilibrium. So in a large range, equilibrium's a decent point. In a small range, you're looking at where's target 1, where it could go and potentially reverse, like relatively equal lows. First presented fair value gap is this, by the way. Breakaway gap. It is okay to use the 9:30 candle today as a first presented fair value gap because we had that 8:30 high back news, but there's no fair value gap there. So you go to the next one, and that's here, incorporating the volume imbalance, that little gap, that tiny gap there. You have to account for that in your fair value gap. Now, if the wick from the volume imbalance goes past the midpoint of this gap, if that wick traded past this mid dotted line, that consequent encroachment level, then it wouldn't be, you wouldn't account for the volume bounce. Then you would draw it to wherever the wick was. But when it's in the upper half, then it's fine. The gap isn't there on MNQ. Damn. Oh, it is. Oh, the volume balance gap. Yeah, with NQ and MNQ, you'll see a lot that the volume balances aren't in great correlation. That's why NQ is better to look at. But pick one. Whatever you're going to be trading on, pick one. Don't look at MNQ and then NQ as well. If you're going to trade on NQ, just look at NQ. If you're going to trade on MNQ, just look at MNQ. I'm saying MNQ and NQ a lot. If you're going to trade on the micro, analyze on the micro. Don't switch between the two because they will have slight discrepancies. It's just going to confuse you. It's not worth it. Okay, I'll take this data high off. So we filled in slightly past the 0.5 level, or consequent encroachment of the opening range gap on the 1 minute chart. The 15-minute chart, it's actually much cleaner. We closed on the consequent encroachment level, and then we opened up on it and we traded up. Yeah, look at that for respect. It's probably random. And look at that, just slightly colored outside the line, slightly. Pretty nice though. So it trades below 8:30 opening price and midnight opening price by just a couple of ticks. How many is that? 3 handles. That's smart money buys because it's a deep discount now relative to the daily range. If you're near the 8:30 opening price and midnight opening price and you're expecting expansion on the day, on a CPI day, you are expecting expansion, then you really want to be using midnight and 8:30 if you're in close proximity to them as discount and premium levels. And that's very important going into the 9:30 a.m. session. Oh, we're in the macro now, so macro. Okay, so that's an institutional order flow entry drill where we create a fair value gap or an inefficiency or a BISI, whatever you want to call it. And then we just go into it a little bit. Simple definition. We just go into it by a little bit. That's a unicorn setup. Low, high, low, high, high, low, low. Back above it, so we invert that breaker. Inverted breaker block, institutional order flow entry drill. It's a unicorn setup. And then down close candles are supporting up close candles. So we trade above down close. And then we are supported by those down close candles as bullish order blocks. Leaving those wicks there and then closing back inside the PDO is a really good sign of incoming speed. So that's good. These two highs engineered liquidity. We put in a high, drop down, put in another high, close, and we displace away. Discount pricing by going below midnight open, below 8:30 open, trade back above. Here's your entry, or an entry. And then you want to see this take out now. So anything, because we want to see this taken, anything on the sell side here, sell side delivery, would be a suspect delivery. So if we trade lower with 4 consecutive down close candles, you would want to anticipate it to be traded back above, so back like that. But are you only limiting yourself to be looking at longs after it goes back above this and gives you the change of state of delivery? Not necessarily, because if you're getting that state of delivery to the sell side, then you drop it into a bullish order block and you have an underlying bullish narrative of trading into these relatively equal highs, or these engineered highs. And I guess this is a mini market maker model as well. Plus we've got that level of discount pricing here. Broke away, plus institutional order flow entry drill, and the breaker block, inverted breaker block. So that's a really good pattern, and here's a pattern. You can expect this bullish order block to hold the support going into these engineered highs. I'm losing my voice. Damn. Okay. Remember what I said earlier about inversion fair value gaps? you don't want to see it trade back into the extreme. So you don't want to see it trade into a low, which it looks like it is kind of here. It can still perform. It's just not as high probability. The best setups are going to come from when it just respects the midpoint or fails to reach the midpoint and trades higher. After this macro is done, I'm going to go because I got to rest my voice. Tomorrow I'm going to teach, actually not tomorrow, on Saturday we're going to do, I might do a stream, I might do a video, I'll have to decide, but it's going to be an SMT lecture where we just talk about SMT. We're not going to do it over a live chat, it'll be like how the implied dealing ranges or grading implied ranges lecture was, where we just go through examples. And it's not going to be super deep, it's just going to be enough surface level stuff. I'll teach you stuff with the dollar and ES, YM, a couple little gems, but mostly it's going to be something you can use as confluence in your analysis. So yeah, nothing too deep. These are the times and the conditions where if you have a trade, you got to journal the shit out of it. Every impulse you get or every time price goes against your will, or it's doing what you don't want it to do, it's going against your position, you feel that little voice in you thinking, oh, I really don't want it to go against me here. I really don't want it to tag me out. I really don't want it to start reversing. I want it to respect this. Please respect this. Those thoughts, everybody gets them. When you're getting them, you have to just journal. Have your journal, if it's on paper, if it's digitally, you gotta journal the shit out of that, and you do it as it's happening. Even if you have to take your attention away from the market for a bit, it's better that in at least a few of your trades, you're giving yourself the perspective and you're writing it down so you can realize what you're thinking in live price action. When you realize at which points you start to feel that voice inside you thinking, or the over leveraging voice, or the over trading voice, or the fearful voice, whatever you struggle with, when you start feeling that inside of your mind, or you start feeling physical symptoms like a rapidly beating heart or sweaty palms, or you're getting really warm, hot flushes, those symptoms, even if they're physical symptoms, when you start feeling that, you have to realize what's causing it. Are you over leveraged? Are you over trading? Are you not confident in your setup? Are you realizing now that price is going to go against you? Have you realized that you did the trade wrong? There are so many different variables, and the only way you'll figure out which one is what triggers that little voice inside of you is by journaling it, writing it down, whether it's on paper or digitally. In live time, in real time, as you're in that trade, is when you should be journaling. Obviously not exclusively, but at least for some trades. Especially if you realize, oh, I'm over leveraged. You can take that chance and realize that this is a learning opportunity, journal it, and you'll figure out what you need to take away in terms of maybe you're analyzing wrong, maybe you're doing your analysis wrong, maybe you're oversized, maybe you're there's so many things that it could be. Maybe you pyramided to your trade and it was a winning trade. You added 3 contracts when it took the low because you thought it was going to be a turtle soup and it's going to keep going higher. And everything looked like it was in alignment. It was the right time. You had the bullish draw. It trades below the low. You add 2 contracts to your 4 contract position, and then it goes into drawdown. You add it to a trade, and then it became a loser. That's why I actually don't recommend you pyramid your trades yet. You'll get to that level eventually where you can start looking to expand your horizons, but until you master a little bit of technical analysis and whatever approach you're using in terms of your model, this is a silver bullet mentorship, so I'm going to talk about silver bullet. If on the first fair value gap you buy, and this is a breakaway gap, and then it trades back into the breaker and you pyramid it, if it trades below that now and you're in drawdown, you're going to feel the impulse to take that trade off, but you have to resist that. If you're in a beginner stage, I wouldn't recommend you pyramid it at all. I would recommend 1 entry, 1 stop loss, 1 take profit, done, and a partial, at an equilibrium of a range or whatever. Beyond that, I wouldn't recommend pyramiding until you're later on in your development. But say you do, and then you start getting that little voice inside of you where you're feeling like you should get out, or you're desperate for it to go your way. That's very dangerous, and it's going to build up bad habits. Although you might think it's going to make you numb to the feeling, really it's not a good type of numbness. That's gambler's numbness, because you're thinking, oh, I just added to it, who gives a fuck? Whatever happens now, whatever happens. It is what it is. That mindset is actually very dangerous in trading. In life, it's a great mindset. It is what it is, whatever happened, happened. But in trading, it's very, very harmful. You have to take accountability. Every single time you do the trade wrong, ask yourself, is there something I did wrong? Go in Discord, ask everyone else, is there something I did wrong here? Whatever. Get external feedback. Sometimes there won't be anything you did wrong. The model just doesn't perform, price action doesn't deliver, whatever happens, happens. But usually there's always something. Whether it's you didn't identify that you're in a high resistance condition, whether you failed to realize that you're in the premium of a range and you just bought, and then it drops into discount and then you get stopped out or whatever. Whatever it is, that mindset of, oh, it doesn't matter, that numbness is very, extremely harmful. And it has a multiplier effect where it happens once, it's easier to happen again, and it's easier to happen again and again and again. So you have to refrain from falling into that habit. And sometimes in Discord people make that little joke, oh, full put longs, whatever. It's funny, it is funny, but then I feel like you are putting that thought into someone's mind that maybe I should full put longs, because I remember I would read that in like Telegram communities, and I would think, okay, these guys are bullish, and then I would look to buy and get fucked. Everything you said about emotions is right. I burnt myself on shorts and then got really pissed and re-entered. It went to TP, but I don't feel good about it. Journal the shit out of that. I get that you don't feel good about it, and that's a good thing, because now when you open that journal up and you write whatever you're gonna write, positive reinforcement. Don't berate yourself. And next week when you open that up, because like Thursday now, on Monday or on Sunday or whenever you reflect on that journal, you'll realize how stupid it was. No offense, but you'll realize that if I just don't overtrade, I'd be profitable by now. If I just didn't over leverage, there would be more money in my bank account than not. So journaling is really important. Really important. And if you just took that loss, Dennis, then take the opportunity, because even though you took the loss, you can turn it into something else, turn it into a lesson. Highs taken, should we expect shorts or anticipate them? I don't know, I'm not really focused on the charts. We have previous day high, we have all-time high. You kind of want to see how it reacts to this, because that's a significant high. an engineered high. So you want to see if it wants the turtle soup or if it wants to retrace and then just go higher. I don't know. If you get stopped out in a trade, do you disregard your analysis, or do you often find yourself trying to trade back into a rebalancing act of the market if the trend in the other direction isn't promising? If I get stopped out, I don't disregard my analysis. I know my analysis isn't usually the reason I get stopped out. Sometimes it is, but it'll be my entry that goes wrong and my stop loss that goes wrong. That's for me though, because I just, I'm at that level now where it's usually me that does the execution wrong, not the analysis. Because if you go into daily analysis in Discord, how often am I getting that wrong now? I feel like 80% of the time is correct. But if I'm on an intraday chart, for example, like what we have here, and I sold up there, and then you know, I didn't take a partial, and I got stopped out for the full amount, would I disregard everything? No. Would I recommend you get it back into a trade? No. I would say don't disregard it, tape read it, don't demo trade it. People think, oh, I lost real money, I should go back to the level of demo trading and lose fake money. No, you should just tape read and realize and journal what you did wrong. Eventually, you'll get to a level where you haven't got the emotions involved, and your technical analysis is just your technical analysis, and it gets wrong and it gets wrong, and you can re-enter on that. Whether you have that confidence because you've done it so many times, you don't have the emotions anymore where you got physical symptoms, where you get nervousness, where you feel that inner voice back. You'll just be at the level where, okay, disrespected the gap, that's fine. It's probably an inversion gap, I can sell here. Most of you aren't going to be there yet. So don't try and act like you are by taking it on the entry. Be honest with yourself. You don't need to go around parading it, but if you're not ready for it, you're not ready for it. The only person you have to like really, really trust in this industry is yourself, and if you can't do that by being honest with yourself, then you're not going to make it. So what I'm saying is you should be able to rely on your thoughts, and if your thoughts say, I don't like this price action, you can get out and you have no second thoughts about it. You don't have, oh, maybe I made the mistake, maybe I should have stayed at the charts. But to build that up, you have to make the right decision a lot, because that way you can trust your decision is going to be correct. The only way to do that is through time, experience, doing it, being in a live market, not necessarily risking live funds or demo funds, but just understanding where everything happens, how it happens. That's why data collection and backtesting is so important. Yeah. But you see so many people, I think we were talking about today or yesterday in the Discord, where they're milking Apex accounts. And they have like 20 different Apex accounts, and they make 1K on an Apex account, but because they're copy trading it across 20 accounts, they made 20 grand in like a 5-handle move. You have to shield yourself from that type of stuff, because it makes you think that what you're doing isn't enough, but it is. You don't need to live up to their expectation. What's your goal in trading? You're not going to reach your goal within a year or 2 years. You're going to reach it in 3 or 4. Well, I can't just say 3 or 4, but what I mean is, whatever your goal is, whether it's replacing your income or supplementing it or replacing some portion of your bills or whatever, maybe you want to make 7 figures a year. That's going to take time, and you'll compare yourself on social media to me or to other people, where you're seeing their years of work, but you're seeing it through a social media post, or you're seeing it through 5 minutes of them trading, or you're seeing it through. You're not seeing what they did to get there, if they are actually there, because some people are just lying to you. Some people are affiliated with firms. They'll fake payouts. whatever it is. Shield yourself from that, because putting that expectation of what you should be or what you could be against what you currently are is just extremely harmful to your mental health. It's stressful. Your development as a trader, you're slowing your progress down. Be content. I'm not saying be content with enough and don't let your trades run. I'm saying be content with where you are, but improve on it. So the majority of you are here because you're learning a model. To learn that model, you have to tape read, backtest, forward test. You have to put in a lot of time, a lot of work. And when you see other people on social media achieving the results that you want, and you haven't got, um, it does something in your mind that you haven't achieved it, but they have. It puts, I don't know if I'd say jealousy, but a desire to want it. And that means you end up trying to skip those steps of backtesting and tape reading and forward testing on a demo, because those are steps you can't skip. It's like going to university. If you want to graduate, you want to get that degree, you got to go through 4 years of study. With trading, it's not going to be 4 years. Well, maybe it will be for some of you, but if you really work hard at this, it could be 1 year and you're profitable. But you can't skip the tape reading stage. You can't skip the demo trading stage. You can't skip the forging discipline by sitting there with the opportunity to make money and just sitting there watching it go by. That level of discipline is only built by putting the time in, doing the motions, taking that Miyagi-Do approach. If you've seen Karate Kid, everyone's seen Karate Kid. Amazing movie. Where you have to just do the actions without even knowing what you're doing them for. Why am I sitting here watching the trade go by me when I could be in this market, tearing it up and making money? It makes no sense. You could have more money, but you're forging discipline. You're putting the investment now into the asset being your trading skill. The better you get now, the better you'll be a year from now. So everything it shouldn't be about money at the moment. It should be just, what's going to take me to the next level of understanding these markets, understanding myself, being able to execute on these trades effectively, being able to mitigate my risk, being able to pyramid into positions. How can I do that and still be a winning trader? What's going to take me there? It's tape reading, backtesting, data collection, forward testing on demo. Those 4 things, it is literally just, and studying the mentorships, whether it's mine or ICT's. You can't skip those. People want to skip them. People want to take shortcuts. People want to skip the ICT rants. You probably want to skip this rant. You can't. There are no shortcuts. You can't be watching ICT's videos in 2x speed and think you're going to get any of the information. You can't be not making notes. You have to be looking at, diligently studying, putting in time. 30 minutes a day is an effort. That is an effort. Hard, cold truth. That's nothing. A child could do that. I used to do at 15 way more, way more than that. If it's 2 hours a day, 3 hours a day, something where you can feel like you've actually put in effort. Because that's the only way you'll actually reap the rewards of what you're doing. Okay, let's read the chat. Valorix rants are so much better than ICT. I don't have a religion, but this is close. Oh, you mean trading? Fair enough. I feel like everyone actually worships something, whether it's money or, I don't know, attraction or attention or God, whatever it is. Everyone has something they're chasing, 95% fail, but that isn't true when you 5 years deep. The longer you stay, the better the odds become. Most don't know this. Hell yeah, hell yeah. I'll say after watching all 2022 and then going to get started. The no-run version immediately after works pretty well for retention. Yeah. I recommend that as well. Go through the 2022 mentorship. the original one, and then you can go to the no rant, because you're shortening that forgetting curve where you'll forget it in a week, but then when you go to the no rant, you're reinforcing all the essential information to shorten or to lengthen whatever that forgetting curve. But I'd say you have to watch the original version first, because the rants that are cut out in the no rant version, some of them are pretty good and they have gems. W stream, thank you, Alex. Okay, my voice is going, so I'm gonna cut it off here. I'll join Discord for a few minutes. I'm gonna go get some food, have some tea, soothe my voice, and yeah. So tomorrow's Friday, so we'll stream tomorrow as well. If you've been here, hopefully you've come away with something. Hopefully you've learned something. We didn't cover that much technical analysis today. We just recapped some stuff. We talked about CPI. So every month there's going to be CPI. So go back to the start of the stream where I mentioned about all the institutions, what times they come into the marketplace, where you should be looking for entries, where you shouldn't be looking to trade at all. That's the important stuff. And then that little bit at the end, that monologue. But yeah, I'm ending now. See you.